Right now, retail investors are completely distracted by short-term market noise and macroeconomic headlines. But while everyone is looking the other way, the smart money is quietly stepping in. Wall Street insiders are aggressively buying the dip on one of the biggest software giants in the world, and they are backing it up with a historic $50 billion buyback. I'm talking about SalesForce, ticker symbol CRM. The market is currently pricing this as a legacy software company, leaving it stranded 27% below its 52-week highs. But they are missing the massive paradigm shift happening under the hood. SalesForce isn't just a CRM anymore. They are building an Agentic Enterprise monopoly. Welcome back to StockScope. Let's look at the data. To understand why insiders are buying, we first have to strip away the narrative and look at the raw cash flow. Fiscal year 26 was an absolute fortress of a year. Total revenue hit $41.5 billion. But the metric that actually matters to institutional capital is the operating cash flow, which came in at $15 billion, up 15% year over year. That translated into a massive $14.4 billion in free cash flow. But here's the ultimate safety net. Their remaining performance obligation, which is essentially guaranteed future revenue sitting in the backlog, just surged to $72.4 billion. They have years of compounding top-line stability already locked in. When a company generates that much excess cash, the question becomes, what do they do with it? Well, management just answered that by authorizing a new, unprecedented $50 billion share repurchase program. This replaces all prior authorizations and sends a massive signal to the market. They aren't just making promises either. In FY26 alone, they already returned $14.3 billion to shareholders, mostly through aggressive buybacks. Top that off with a 5.8% dividend hike to 44 cents a share, and you have a heavily secured yield. They are literally shrinking the float to force the earnings per share higher. But buybacks are corporate decisions. What are the individuals inside the company doing with their own money? They are buying. In March, Director David Blair Kirk dropped over $500,000 of his own cash to buy 2,570 shares at an exact price of $194.62. Combine that with Value Act Capital's massive $25 million stake, and you start to see a very clear picture. When insiders buy at these levels, they are planting a flag in the ground. They are telling Wall Street that the current 27% discount is a massive mispricing of the stock's intrinsic value. So what is the catalyst that the market is mispricing? It's the AI pivot. We aren't talking about basic chatbots here. SalesForce is scaling what they call the Agentic Enterprise. In FY26, they delivered a staggering 2.4 billion Agentic Work Units and processed 19 trillion tokens. These are autonomous AI agents actually doing the work, closing tickets, analyzing data, and automating workflows. This is the holy grail of enterprise software efficiency, and Salesforce is the one executing it at scale, and it's already translating into explosive revenue. The annual recurring revenue for Agentforce and Data 360 just crossed the $2.9 billion mark. That is a 200% year-over-year explosion in growth. In the fourth quarter alone, they closed over 29,000 Agentforce deals. Let that sink in. The enterprise adoption rate here is off the charts, because companies realize that if they don't integrate this AI into their sales and data teams, their competitors will. Looking ahead to 2027, management is playing it smart. They are guiding for revenue between $45.80 and $46.2 billion. But the real institutional hook here is their margin discipline. They are projecting a non-GAAP operating margin of 34.3%. So despite spending billions on AI infrastructure, they are maintaining elite profitability. Furthermore, they are signaling a structural organic revenue re-acceleration in the back half of the year, as these Agentforce implementations hit critical mass. CEO Mark Benioff isn't thinking small. He has laid out a clear, long-term target to hit $63 billion in revenue by fiscal year 2030. This isn't going to come from just selling more traditional CRM seats. It is going to be driven entirely by the tailwinds of agentic AI. They are positioning Data Cloud to be the central nervous system of the modern corporate world. Let's weigh the reality of the situation. The bull case is incredibly strong. Salesforce is the undeniable #1 AI CRM monopoly. They have an absolute floor built by insider buying, and Data Cloud just ingested 112 trillion records, a 114% jump. Data is the new oil, and they own the refinery. But the bear case is why the stock is down right now, and we have to respect it. They just made a massive $9.2 billion acquisition of Informatica. Integrating a company of that size introduces huge operational risk over the next 12 months. Throw in a $300 million foreign exchange headwind, and the fact that they have to burn $5.99 billion in R&D just to fend off AI competitors. And you can see why the market is currently acting skittish. Looking at the technical setup, the chart tells the exact same story as the fundamentals. The stock is currently trading at a highly compressed 27% discount. We are sitting right inside the primary institutional accumulation zone, between $185 and $195. That $194 level is exactly where we saw the heavy insider buying, which validates this zone as a high-conviction entry point for capital allocators willing to ride out the short-term M&A noise. If they execute, the upside target here is easily 25 to 40%. So what is the stock scope verdict? We are placing SalesForce at a hold with a moderate accumulation on a margin of safety. We are not issuing a blind strong buy here, because the Informatica integration risk is real. However, the Agentforce momentum is completely undeniable, and the smart money is actively building a $50 billion fortress around this stock. If you get the chance to accumulate shares alongside the insiders in that $190 zone, the risk-to-reward ratio is heavily in your favor. Trade the data, respect the margin of safety, and make sure you subscribe to StockScope for our next institutional deep dive.